Hey, good morning, everybody. Good morning. Oh my God. It's been a long day. It's been a long day. Good afternoon. I am the Stock Doctor, also known as Lee Seiler. Thank you very much. And you know what? We are a little bit ill prepared this evening because I hit the camera a little bit sooner than I should have, but that's okay. But thanks for joining us. And the number down here on the bottom, 407-831-8002, or email Nikki at stockdr.com, and we'll answer your questions. But again, thank you. And it is our Hump Day Market Update. And I have to give props to Courtney Prince, who comes up with some really creative little Hump Day, Hump Day, that kind of stuff. So let's talk about, we're going to go over some stuff tonight that is really interesting because there is a lot of people out there using those investing apps, Betterment and Robinhood and all that. And that's all, as long as you're investing, I'm good with that. Okay. But the reason an advisor is critical is because an advisor can help protect you from yourself. Now, always, they're awesome. Tom and Rita, thank you very much. You guys are awesome. So we try to protect you from yourselves. And I've got those clients that call up and say, hey, what do you think of this? What do you think of that? And hey, it's their money. We manage it. We get paid to manage. Understand how we work as a fiduciary, as a financial advisor. The way we work is I charge a percentage, which is a really low percentage, by the way. And that percentage stays there. So if I make you 10% or 15 or 20 or 5 or we go down 10, I participate in that move. I participate in that action. So our incentive is that since we're on your side of the table is to do the best we can for you. That's how it works as a fiduciary and as a fee-based asset manager. That's what we do. And the other thing is, because most, and I'm going to say most, which I think that's true, most independent financial advisors like us, which we don't work for Morgan Stanley or SunTrust or Wells, you wouldn't want to, we have nobody on top of us saying, we need to do this for the client. You got to do this. I want you to buy the best Merrill Lynch fund. I want you to buy this Morgan Stanley fund. It's great. And they do have some great funds, I'm sure, but very few of them are great. So my point is, we take the entire universe of investments and find the best that is most suitable for our client and meets their risk tolerance. So, that being said, let's talk about what the markets have done over the last week. So last week, we had a really, really strong week in stocks. I think that the market is way ahead of the economy. That's my feeling. However, that being said, I think that we are taking advantage of it. We're making money, all right? And to go back about that Robinhood situation or Betterment or whatever, I think there's a lot of people out there, they think they're starting to see a little bit different turn in the market than the easy money, because somebody talked to me today and asked what I thought of the market. And I said, well, I think that the easy money has been made. The money that when you bought at the end of March 23rd, being the low of the market, which I called, that the easy money's made. That's all gone. Now you're going to have to work and you have to fight for it. All right, you're going to have to find the right opportunities. And I'll talk about some opportunities that I found recently and that I like. And some opportunities I found, I liked it, but didn't work out. So there's always those that don't work out. So let's talk first of all, and I'm going to all right, we'll talk about the markets in general. Let me just get those charts up, if you don't mind. Thank you very much. I appreciate it. And by the way, tonight's evening is sponsored by the Post Time Lounge. Post Time Lounge is an icon in Seminole County. It's been here forever and ever. And not that I ever was in it, but it's been here so long, it was a redneck honky-tonk, okay? I'm not being offensive to anybody that's country-oriented. It's bullshit. But anyway, it used to be a redneck honky-tonk. And now it's a rock and roll bar. And it's a great rock and roll bar. So thank you to the Post Time Lounge. You guys are awesome. And by the way, it's not just drink. It's food. They have, by the way, I'll tell you this. I can get a blackened mahi Caesar salad there at the Post Times. Phenomenal. Really, really good. So I encourage you to check it out. All right, so let's go what the markets did last week. First of all, last week was a pretty good week. I mean, we had the week previously that big drop in stocks, and of course we had a rally today. I'll go over that, but let's talk about last week first. Last week, the S&P 500 up 4%, the Dow Jones up 3.2%, the Nasdaq up 4.6%, and the Russell small cap stocks were up 4.6%. Now they've been underperforming, then they started a little bit of a rally, and then underperformed again, but now we're starting to see some movement there. So let's talk about, here we go. Now, before we do that, let's go to what the markets did. I'll have you focus there. See that right here? Okay. Today, the Dow was up 177 points, about 0.68%, to close at 26,067. The S&P 500 up 0.78%, 24 points, to close at 3189. The Nasdaq, right here, on a roll, up 1.4%, 146 points at 10,492. Russell 2000, which is a small cap index, was up 0.8%. So better than the Dow and better than the S&P 500 to close at 1437. So now let's look at the charts here, and we'll give you a good idea. So the S&P 500, and what you're seeing here, all right, the big talk today was, you saw the gold cross. The gold cross is when, and we talked about this, so we talk about this every week. I talk about moving averages. Moving averages are trend lines, okay? They are trend lines. So there are different trends in the markets, in stocks or indexes. There are short-term, there's intermediate term, and there's long-term trends. So obviously, and everybody uses slightly different moving averages, although most people use the 15-day moving average, which is the average price over the last 15 days, the 50-day, which is the closing price over the last 50 days, and the 200-day. Those are what most people use. And why do most people use them? Because most people use them. What, are you going to come up with a 36-day moving average? It's not going to work for you, because understand that program trading works on these moving averages. So when something breaks through the 50-day, program trading is kicking in. So you want to do what the markets do. So let's go ahead and talk about, this is the S&P 500, which, let's go back. All right, we do this every week. Sell off, rally, and now we've been sideways. We're not above the high we saw back in June 8th, all right? So we're still trying to get there, but we've been consolidating, and the market's okay. But I think what's happened is the reopening of the economy has not been as smooth as expected. Of course, we're still down from the highs, and certainly down for the year. But there are stocks that are working, all right? And the ones that are working, believe it or not, you should believe it because I talk about it every week, are the FANG stocks. The FANG, and we'll call it the FANG, which is FAANG, and that includes Facebook, which, believe it or not, is working despite them losing a ton of advertisers. That's why I'm concerned about Facebook. I don't own the stock. We've owned it in the past, made money on it like 4 or 5 times. Seriously, we made a lot of money on Facebook in the past. Don't own it now. I wouldn't own it now, because until those things get worked out, they're losing advertisers like crazy. We're talking $80 billion in advertising. That could be a problem. Let me turn the volume down. So FANG, the other part of the acronym, is Apple. Apple hit all-time highs today. For full disclosure, I own Apple personally. Clients own Apple, and we have owned it, and I looked, as far back, because we have only, in my history of owning Apple, we've only sold very, very little, maybe 100 shares or 200 shares tops, and it's my largest position for clients and myself. So we bought it in 2016, started buying it, and bought all the way through. My highest buy in Apple is about 145, 149. No, I bought some at 2, for a client that came in, I bought some at 280 or so. But most of our accounts own it less than 100. So Apple hit all-time highs today. So why is Apple hitting all-time highs? Well, quite frankly, aside from 5G, I don't know. But what I do know is looking at the FANG, which is Facebook, Apple, Amazon, Netflix, and Google. What do most people feel comfortable owning in this economy? Facebook, you're still on there, and you're probably on there more now that you're quarantined or have been quarantined or working from home. Apple, 5G is coming. All right, that's a pretty good opportunity for Apple. And the AirBuds, people are losing them. I make a joke that people lose AirBuds. Okay, we have a question about tax day. Okay, yes, I'll go over that. Which, by the way, this year is July 15th. So, the other A is Amazon. Okay, well, we're all staying at home. I think I get an Amazon package every day at my house. So, Amazon, all-time highs, right near. Netflix, must I say more? You're at home. I've watched every freaking Netflix show in the world. Don't know what I'm watching alone now because there's nothing else to watch. People are 38 days in the Arctic. Are you kidding me? 38 days in the Arctic? Jesus, for $500,000? No freaking way. Can't do it. All right. And then Google, which is Alphabet, but again, cloud technology is what's really helping them. So those stocks are killing it. And what I want to talk about today, not only those stocks killing it, I want to talk about Warren Buffett. Warren Buffett, the Oracle of Omaha. This guy is 90 years old and has had a brilliant career and has done amazing things. And I happen to be a fan of Warren Buffett, and I would probably pay whatever it is to have that lunch with him. I don't know. I don't remember. 25 grand. I probably would do that, because to spend 25 grand to speak with this guy for a few minutes will probably be give me multiples on my investment over time. So one thing about Warren Buffett is he always shied away from technology stocks. Never liked them. Don't know why. Well, I do know why, because he thought valuations weren't there. He's a value investor. And I like value investing because what that means is you're buying a company where the sum of the parts is worth more than the whole, meaning what you're buying is worth more than the stock price. Okay, that's what Warren Buffett does and has been very successful. Although when the technology boom was happening in the big run, hey, Warren didn't keep up with the S&P 500. Okay, whatever. But he got ragged. He got ragged over the last year, recently, over the last 7-8 months when he sold his airlines. He sold airlines. And Warren is a guy who buys value, practical. Warren ended up selling his airlines, which are probably a hell of a lot lower than where he sold them, by the way. And people aren't talking about that. I don't have that number. But I do know what he lost on the airlines, and that's well published. And Mr. Buffett lost $3.5 billion with a B on airlines. That sounds really bad, doesn't it? Mm-hmm. Okay. Well, Mr. Buffett knows a little bit more than you think, because Mr. Buffett took a position over the last few years. I think 2017 he started buying Apple. And now Mr. Buffett owns 250, his equity portfolio, owns 250 million shares of Apple. 250 million shares of Apple. So while Mr. Buffett lost 3.5 billion with a B in the airlines, since March, Mr. Buffett has made 37 billion on Apple. Wow. And I understand that concept because we have made a tremendous amount of money for the clients that own Apple. It's been tremendous. So look, I'm not buying Apple. I haven't bought it since that level I told you, 280, because it pulled back. I cannot buy Apple today. at $381 today, closed at 381.37, which I love because I own a shitload of shares. My clients owed an assload of shares. I can say that when it comes to Apple because, wow. So, will I buy it today? No. It's extended, folks. Look at this. We're talking moving averages, right? The blue line is the 15-day. It's a very short-term trade. It's above that. The red line is the 50-day. The average price in the last 50 days for Apple, the average price for the last 50 days was $330. We're at 381. The 200-day moving average is the white line. $287. That is a long-term trend on Apple. So we love it. I have not sold any shares lately, and I probably should for portfolio management purposes. I've called my clients because we've owned it, and I will tell you this: I have owned Apple since the 40s, the $40 a share. I talked to a client last week, and there's many of them like this, so call me and we can talk to them together, that are up 690% on Apple. And they say, you may think, oh, why would you do that? Excuse me, didn't I just say that we are fee-based asset managers? We're fiduciary. We do what's in the client's best interest. I thought what's in the client's best interest was to hold Apple. And guess what? For that little bit of Apple that I own for clients, my income has appreciated 690%. Does that make sense to you? Because I'm on your side of the table, clients, because I know a lot of clients watch this. We work for you. We want to make sure you do well based on your objectives and your risk tolerance, because that's critical. I'm not saying that if you're not a moderate investor, you can't hold Apple. You can, but you have to have the other stuff too that goes along with it. All right, so Warren Buffett, awesome. I really appreciate it. So here's what I'm afraid of, is I think that we have this rally here, and it is FOMO. FOMO is Nikki will correct me, but I think it's a millennial acronym that states fear of missing out. Okay? FOMO. So people are buying whatever they can buy on Robinhood or Betterment or any of that bullshit, and the markets are flying. Look, does Apple deserve to be at 381? Personally, I don't think so. No, I'm not saying personally. Personally, hell yes. Technically, and my investor hat on, I don't think so. Look, 5G is going to be huge, and that's a disruptive technology that it's not going to be from 4G to 5G, you're going to be up 25% in speed. No, it's exponential. But what I'm concerned about is that there are people out there with their little Robinhood accounts and their, the average. Hey, Nick, what's the average age of the Robinhood investor? 36. Thank you very much. I appreciate it. Yes, we have a sophisticated intercom system here at Charlotte Wealth Management. I thought it was younger than that. Okay. So 36 years old. And again, I don't knock it. I'm saying it's great if you're 36 and you're investing, you're buying some shares of this, because I'm going to show you also Amazon. Amazon up $81. Now, okay, that's 3%, but this is Amazon. Right here. Look at that. Look at that run. Yes, I own Amazon personally. We own Amazon for some clients. But here's my concern. Amazon is a stay-at-home stock. There's no doubt. People are staying at home. The 200-day moving average currently sits at $2,054. Amazon today closed at $3,081. Okay, that's 50%. That's not so bad. But here's what I'm concerned about, is that we're having a lot of folks out there chasing stocks. What you don't want to do is chase stocks, because you will get slammed. And when you start getting to where you're over 100% of the 200-day moving average, you're above, 100% above what the stock was trading at for the last 200 days, we have a problem, Houston. So I'm going to give you some examples. And these are stocks that they mean nothing to me. Well, I actually, some do. Let's go on. Let's start with Zoom, which meant something to me. I had some Zoom for some clients. I sold it. The stock closed today at, oh, geez. I can't see. Great. I'm blind. I'm not blind now. Hold on. I literally can't see because it said green color. Bear with me. Okay. Wow, 266. No way. All right, hold on a second. Something's not quite right. I can't see that. Let me get the price on Zoom. All right, so Zoom. Oh, 206. Okay. Okay. 266. So let me just show you where the stock is based on, bear with me. Okay, there we go. Okay. So the 200-day moving average is at 118 and Zoom is at 266. So it's more than 100% above the 200-day moving average. All right, that's one. That concerns me. Let's take a look at the next one. NIO, which is a big holding in the Robinhood. $3.50 a share is a 200-day moving average. The stock closed today at $12.88. 3 to 4 times. Now let's take a look at a lot of people's favorite, and it's Tesla. Here's my concern with Tesla, and you know what? I have not owned Tesla. I have not owned Tesla this year. Guess what? My bad. I should have owned Tesla. Anybody own Tesla? Kudos. I appreciate that. You guys did a great job. And if you're holding it, even better job. I had a friend of mine. He texted me last night and said, what do I do with Tesla? He owns it cheap, made good money on it. Awesome. I said, listen, here's the way you got to look at it. It was like $1,300 at the time, whatever. I said, you have to think about, would you be more upset owning it? All right, keep in mind, let me give you the scenario. Tesla's at $1,300. Probably double, maybe more, okay? Would you be more upset owning Tesla and it went to 1,000, down 300, or would you be more upset if it went up to 1,600 and you missed out on that last 300 points? That's the way you got to look at it. Or, I told him, you're more than double, more than likely. I don't know his cost basis, but it's, I know when he bought it, kind of an idea. Then sell half. Take your chips off the table. Look, for those of you that go to Vegas or do anything else, gamble a little bit. Hey, the rule of craps is try and take your profits off the table. So, yeah, I mean, Tesla's been awesome, and all those ESG funds, which is their environmental, social, and governance funds, have done really well because they own Tesla. But here we go. It's been a rocket. I really look at these last 2 days and I say that it's probably on its way to pull back a little bit. I'm not a buyer. I don't own it. So again, it's irrelevant to me. And then I'm going to show you what happens to stocks that get above over 100% of their moving. By the way, let me go back to Tesla and tell you where it is relative to its moving average. So the 200-day moving average is $591 a share, and the stock closed at $13.65. So that's more than 100%, probably 130%, 140%, 50% of its 200-day moving average above. So that's disconcerting. So let me just show you what can happen to stocks. And this is a stock I have a small position in, only for people that can assume the risk, and that's Moderna. They're looking for that vaccine for coronavirus. Let's look at the spike on the biotech. All right, let's look at the spike here. That spike, the stock hit $87. You see that up here, folks? $87 a share. At that point, the 200-day moving average was at $24, 4 times. So it went from 87 now down to 60. It's still not here yet, but it's more manageable because now the 200-day, which, by the way, because the stock ran up. This 200 days trending higher is at $32. So again, you can't be owning stocks that are up 100% above its 200-day moving average. It's just really, I'm not gonna say irresponsible. It's crazy. Okay, crazy. By the way, we have questions. Okay. Thanks, Nick. Okay, Cliff asked, with the U.S. economy uncertainty, would investing in international markets be a good way to diversify or hedge? Okay, Cliff, the question is, with the U.S. markets instability, craziness, would it be nice to own outside of this country's assets? Yes, I do believe that. I think the emerging markets are an incredible value, and there is a fund, an ETF that I like, ETF exchange traded fund that I really do like. And they are, they pay a great yield. They're paying over almost 3.5% dividend, and the stocks within the portfolio trade at half what the S&P 500 is. So yes, I do believe that there's opportunity internationally, and I'm not saying just emerging. I say developed markets as well. So I think there's great opportunity there, and I think every portfolio should have some international exposure. Absolutely. Let's take the other question that we got was tax day is coming up, and we'll talk about the IRA contributions. Yes, because of the coronavirus, tax day has been extended to July 15th. So today is July 8th. You can open an IRA, depending on, again, there's some qualifications. You got to make sure that you don't make over a certain amount, et cetera, et cetera. We can do that for you. But you can, if you're under 50, you can put $6,000 in an IRA pending income situation. If you're 50 or over, you can put $7,000. That's the catch-up provision in an IRA and or Roth. So I will say this: we can do that for you as long as you come to the office by Friday. After Friday, it's going to be difficult because we've got to make sure a check gets there and all that. I don't want to fight the IRS. So if you'd like us to help you with an IRA, if you have an existing IRA that you want to transfer in, you want it properly managed, we're your group. All you have to do is email Nikki at StockDR or call the office. We'll do that for you. So those questions. Anyway, we're going to wrap things up. But I want to talk about, before we go further, I mentioned Apple, and I talked about how 5G is critical. 5G is critical, but there's other things that are critical inside what's going on. I'm going to talk about some stocks that I bought recently. But cloud technology is only going to get more usage. So there are ways to participate in 5G and cloud as spokes. You look at a portfolio as a hub, your core holdings, and a spoke approach. Let's have a little bit of a sliver of this, a sliver of that, to kind of beef up performance if possible. Robotics, that is not, to me, as important as 5G, cloud. Actually, of the 5 disruptive technologies, robotics to me is my least favorite. So what I'm going to do is go to the other 2, which is biotech. We see what's going on with Corona and companies trying to come out with a vaccine, a cure. That is huge, and biotech's going to continue to do some great things. And lastly is cyber security. I don't see anybody spending less on cybersecurity, because what's going on in the world and you're getting hacked, emails and all the bullshit, that to me is just a nightmare. So let's talk about, I bought something yesterday. I'll talk about it. Sure, I'll do that. I bought some shares in Lennar Homes. Sorry for my buddies who are home builders, other places, but I did buy some shares of Lennar. Here's a chart of Lennar. You had the sell-off, the rebound, and the sideways trading, volume kicking it up. One of the things I like about Lennar, one thing I like about home builders in general, is that because of Corona, folks are moving out of densely populated areas. They can't even keep up with the demand. When I say Lennar, I mean home builders. They can't keep up with the demand. It's unbelievable. So, owning home builders, and people have made money on them. I have not made money on home builders in a while. I bought it yesterday, and I thought it was a good play. There's funds that you can buy a home building fund if you like. I mean, I can give you that suggestion if you call my office. But anyway, I like the stock a lot. I bought it yesterday at $63, and today it closed at $65.55. So I was up $2.50 in a short period of time. But it really looks like it wants to go much higher. And what I'll do is let me try and find that other chart for you because those are a little bit better to watch. Okay, let's take a look. Let's go. I'm going to slide it over here. There we go. So what I'm going to do, come on, catch up. There we go. Let's go to Lennar on this one because you can see it a little better. Okay, so as you can see, Lennar right here, it is really trying to volume kicked up today a little bit. If it breaks out of here, it'll challenge 71 level, and it's 65.55 right now. I do like it. I think that the stock's going higher. It's probably, you have earnings upgrades. It trades at a low multiple, trades at 9 PE. That's really, really cheap relative to the market. I like the stock a lot. Another stock that I bought a week ago is a company called Dexcom. And Dexcom is really interesting because it is really involved in glucose monitoring. So really for diabetes monitoring. That's what they do. But they also own Roto-Rooter. So I bought some shares in here at $380. Stock closed at $435. It broke out all-time highs. My concern is the volume wasn't there, so that's a little bit disconcerting, but I do like what I saw here. And earnings upgrades, you want to see that companies out there, the broker-dealers are upgrading their earnings. So that's strong. I will talk about stocks I don't own that look interesting. And here are, I'll give you Pet Med Express. Look, we all love our dogs, our cats, our animals. But what we're seeing here is really a nice move with some big volume breaking out. Earnings have been upgraded. The ticker symbol PETS. I do like the stock. I don't own it. I should have bought it today. I did not. I want to see what happens tomorrow. If I can pull back a little bit, I'll probably take a position in it. I do like that. It's very interesting. Now I want to talk about a stock that is extended, and I like it, but I think it's too extended for me to own. And this is Chegg, which is, you can actually rent books from Chegg or online with online learning and all that going on. Chegg is an incredible company. CHGG. Stock's made a huge move. This move right here was in May when everybody figured out that, hey, guess what? Corona's going to keep everybody at home. The stock ran from 45 to 67, pulled back to 55. Now it's 72. I don't own it for clients. I'm a little nervous because the 200-day moving average is right at around 43 and the stock is at 72. I think it could pull back a little bit. If I could buy it, high 60s and mid 60s, I would. That's Chegg, CHGG. So I want to thank everybody for joining me and who will join me because it's guess what? It's recorded. So, but you know what? The bottom line is I'm Lee Seiler, and I'm the Stock Doctor. If we can help you with your money management, just call us. The number's right here, 831-8002. Email Nikki. We have some great people in this office, and we do some great things for our clients. I appreciate you guys. I'll see you next week. Everybody have a great evening and a great rest of the week.